Welcome to our monthly series, which gives some additional information on our current asset allocation and the decisions we have taken. This month, a main event focuses once again on central banks. Indeed, the European Central Bank, in its meeting on September 9, made some policy announcements. On our side, we have decided to become even more negative on European bonds, introducing a double underweight on sovereign bonds in the Eurozone and in Switzerland. First, let's look at the current stance on global central banks. One of the major features of the last 10 years is the impressive rise in asset purchases by central banks, which has led to a mind-blowing increase in central bank balance sheets. It is likely that by the end of this year, central banks' balance sheets in advanced economies will get even closer to $30 trillion, whereby 40% of that increase is due to strong QE intervention during the current health crisis, the COVID-19 pandemic. This summer, the US Federal Reserve, the intellectual and practical guru of major central banks, hinted that asset purchases will diminish in the future. In Europe, the Bank of England followed along that path, while more recently, the European Central Bank announced some policy changes. Indeed, during its latest policy meeting in early September, the ECB basically announced that it was going into a less dovish direction. This can be seen by two main elements. First and foremost, bond purchases via the PEPP program will proceed at a moderately lower pace. Second, the upward revisions in the ECB's internal projections, in particular on inflation, suggest more confidence in the outlook. Overall, the latest ECB decisions can be interpreted as a mildly hawkish decision. Our view is that the ECB will remain on the prudent side, and we do not expect any major policy changes on the PEPP program. A decision will be taken in December. We expect purchases to continue until March 2022 at least, and the ECB to possibly announce an extension. Alternatively, further QE could be done via an expanded APP program. We note that purchases could be lowered by very little, from 80 billion euros per month to a 70 billion euros per month pace. Also, relative to sovereign debt issuance, which typically declines in the fourth quarter, QE in relative terms of issuance will remain strong. On the macro side, we note that the longer-term 2023 inflation rate, though upgraded by 10 basis points from the previous one, at now 1.5%, remains far below the 2% new target. Indeed, it remains too far below the new target, and that is one main reason why we do think monetary policy will remain extremely accommodative in the Eurozone. Now, as to concrete investment implications, we keep our global underweight on fixed income securities. In line with our US and UK exposures, we introduce a double underweight on sovereign bonds in the Eurozone and in Switzerland. Indeed, we believe that since risk in sovereign fixed income securities is asymmetric in these areas, there's significant upside potential in yields. Thank you very much for your attention.